ICT fair value gaps tell you where smart money is positioned. The Confluence method tells you when to actually pull the trigger. Trading FVGS alone is a 50-50 bet because the same chart can show 3 or 4 FVGS and you can't tell which one matters. Today, how to layer fair value gaps with anchored VWAP and horizontal key levels to isolate the FVGS that institutional positioning actually defends fractal across every time frame. Here's the stack. Layer 1, the fair value gap, 3 candles where the first and third don't overlap. Leaving an imbalance, the algorithm tends to rebalance. Layer 2, an anchored VWAP from a recent high volume bar, earnings day, swing low breakout candle, which acts as the institutional cost basis from that anchor. Layer 3, a horizontal key level, a prior swing high or support the chart has defended before. When all 3 coincide at the same price, you have 3 independent reasons for that level to hold. Each layer alone is a coin flip, 3-layered is a structural edge. The problem with trading FVGS naked. A real chart will show 3 or 4 fair value gaps in a single session. The ICT framework says price tends to return to fill them, but the framework doesn't tell you which gap matters most. Without an additional filter, you're guessing which level the algorithm cares about. Some gaps fill and the trade works, some never fill or get blown through. FVGS alone are descriptive, not predictive. They need a second filter to become tradable. Here's the key. Anchored VWAP from a meaningful bar, an earnings gap, a major swing low, a breakout candle gives you the institutional cost basis from that anchor. Drawn forward, it shows where big participants are net flat. The fair value gap that aligns with that AVWAP is the gap institutions actually defend, because below it, they're losing money on average. Out of 3 or 4 FVGS on a chart, usually only one sits on top of a meaningful AVWAP. That's the one that matters. Now the A+ entry. Price has been trending up, leaves a fair value gap on the most recent push, then retraces. The retracement hits a price where 3 things coincide: the lower edge of the FVG, an anchored VWAP from the original breakout day, and a horizontal level that previously acted as resistance and is now potential support. 3 independent reasons for that price to hold. You enter long on the close that holds the cluster, stop 180 or below it, target the next liquidity pool or measured move. The math on this trade is dramatically better than any of the 3 filters alone. And the fractal part. The same 3-layer logic works on the 4-hour, the daily, and the weekly, and the strongest setup stack across timeframes. A daily FVG that lines up with a weekly AVWAP that sits on a multi-month horizontal level is the highest conviction kind of setup the framework produces. It might appear once or twice a quarter on any given chart, but when it does, you size it aggressively and hold it longer. Fractal FVGS aren't just a single time frame trick. They're a way of recognizing which institutional footprints the algorithm actually respects. So, fair value gaps tell you where smart money is positioned, but alone they're a coin flip. Layer anchored VWAP to narrow which FVG matters, layer a horizontal key level to confirm, and you've got the triple confluence stack that produces A+ entries fractal across timeframes. The Confluence method doesn't replace smart money concepts, it makes them objective. Subscribe for the full method and trade your own plan. Education, not financial advice.